This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manassero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. We have a great show ahead here. This is going to be fun. We're going to be looking at real estate investing from sort of a higher level than we normally do. Our guest today is Paul Caseberg. And Paul joined MG Properties Group in 2010 and is responsible for the firm's acquisition, disposition, and capital markets activities. At MG, he has been involved with the purchase of approximately 22,000 units. Okay, and so I'm talking about a higher level here. This is definitely a lot of real estate there, totaling $4 billion in total consideration. Paul has 20 years of experience in real estate, private equity investment, capital markets, and corporate M&A. Prior to joining MG, he held various roles in commercial real estate debt and equity acquisitions, development, and financing. He has a background in corporate M&A and venture capital investing at Northrop Grumman and holds a Bachelor of Science degree in mechanical engineering from the University of Notre Dame and an MBA in finance and entrepreneurship from the UCLA Anderson School of Management. So, Paul, welcome to the Old Dogs REI Network.
Thanks for having me, Bill. It's great to be here.
Well, it's great to have you here. We got one of the smart guys in the house here, and it sounds like you have a different level than the guys, I talked to that, maybe are flipping a house here and there and that kind of thing. It's just definitely a higher level, which I think is great because I think there's a lot of information from your experience that our listeners are going to really enjoy.
It's just the number of zeros, that's the only difference.
Well, why don't you just kind of give us just a little bit of background on yourself, Paul, where you come from and how you got into this area?
Sure. Okay. So my background is I grew up in Hawaii, which was a fantastic place to grow up. And when I went to college, I went to Notre Dame in the Midwest, and I was an engineer. I was a mechanical engineer. And so I loved quantitative things and numbers and analysis. And after undergrad, I went out to work for Northrop Grumman doing on-orbit operations on satellites, which was great and a lot of fun. But at some point, I fell in love with the finance world. And so I went back to school at UCLA while I was there and made a switch over to our in-house venture capital group. And so we were licensing technology and investing in startups. And I really love the transactional side of the business and the financial analysis. And then the dot-com bust happened. And it was pretty clear that there weren't going to be a lot of interesting opportunities in venture capital for a while, and I was kind of looking for some other things to do. So I did corporate M&A for a little while at Northrop Grumman, but I had some friends in the real estate business and always stayed in touch with them. And I love the sound of it. I like when you're doing corporate M&A, sometimes you finish a big transaction and you come into your office and it looks exactly the same. And with real estate, you buy a deal and you go out and invest in it, and you can walk the property and see the difference, and it's very tangible. And so I just kind of love that about it. And so it kind of sucked me in, and I went from doing corporate M&A over to learn the real estate business by doing commercial mortgage banking. And that was kind of my introduction to real estate, just so I could see a lot of reps and kind of learn how do deals unfold, how do the different asset classes work, and just sort of learn what I liked and what I didn't so I could find a home. So I did that for a while, and then I worked in-house at a large family office that had a real estate group. So I was on the real estate investment analysis side, on kind of the LP side for a while. So I'm familiar with looking through a lot of offerings and trying to figure out what's a good offering and what's not a good offering and who should we put money with. So I did that for a bit, and then before the downturn, actually, I was part of a group where we started a hedge fund to buy non-performing residential debt. And then, of course, the downturn happened, and that turned into a really exciting place to be. It was a lot of fun for about 18 months, but we were a startup, and then a lot of the big institutional players got into that space. And it turned out that what I learned from that was really a trade as opposed to a business. It was kind of an exciting trade at a point in time, and then it went away. And so it was a great experience, though. And that's when I switched over to work here at MG. That was back in 2010. And MG is a multifamily owner and operator. All we do is apartments. We do existing product. We don't do ground up developments. We buy, we rehab, and we hold. And generally, we tend to be kind of medium to long-term holders. Our average hold period is about 8 years. We have about 1,000 private investors, including some family offices, and then we have some family office joint ventures that we do, and then we do some institutional joint ventures as well. We are partners with Blackstone on some deals and have worked with a number of other kind of large institutional groups. So I've been here for about 10 years, and it's just been a fantastic company. It's nice being an acquisitions person to have all this team to work with and to provide information. Because we're fully vertically integrated, we have the construction team, so I can have them walk a property and give me feedback on our approach to roofs and plumbing and siding. And then we have an in-house operations team, and so they look at our pro forma budgets and give us feedback on payroll and our marketing strategy and our rehab strategy. And so having all that in-house has been for me a real learning experience and really valuable, and hopefully helps us make better decisions. So that's how I got to be where I am right now.
Wow. Gosh, there's so many things that you said that I would love to zero in on. I think that your expertise is very multifaceted. Probably won't talk about satellites and things like that, but but it's always interesting for me, and that there are folks, engineers are attracted to real estate investing, and there are so many engineers that I know that are very, very successful real estate investors. What do you think the attraction was for you that brought you into this area?
I think it's funny that you mentioned that there are a lot of engineers, which is true. There are a lot of sort of reformed engineers that get in the space, and I think it's part of it is just the quantitative analysis, and real estate, like a lot of engineering problems, real estate is hard to quantify in a lot of ways. In other words, we model up real estate, and it looks like you have a high level of precision with the way that we analyze real estate. But the reality is there's a lot of uncertainty in the assumptions that we use. And, like the saying goes, garbage in, garbage out. If you don't have good assumptions on the way in, if you're not using an accurate assumption on your rent growth, if you're not using an accurate assumption on your value add or your rents or your exit cap, then it doesn't matter. It blows your whole model, and it's not accurate anymore. And so a lot of engineering is really thinking about what's the level of accuracy on my assumptions, and how do I think about an uncertain system, and how do I put some numbers around that, and then how do I make good decisions in light of the fact that I have perhaps imperfect data. And so I think there's kind of an art and a beauty to that, and that's what I love about real estate is it has a lot of that in common. Is there's definitely a quantitative side of it, but it's not just purely running math numbers. You have to kind of combine that with just some practical judgment and experience about real estate, and knowing what's worked in the past and what hasn't, and what your capabilities are and what you're not good at, and trying to put that all together to make a good deal. So it's fun because, in theory, it seems like it's just a math problem, but in practice, there's just so much that goes into the real estate business that's, relationship oriented with other principals, and analysis oriented, and then just operational oriented. They're just, even the narrow niches of real estate could be an entire sort of lifetime's worth of learning. And that's what's fun about it.
That's interesting. And I imagine too that, especially on the level that you're dealing with, that the economic aspect is one of those variables. Again, you try to project as best as you can what an economy is going to do and what a market's going to do, but we really don't have the control that that we'd like to have. I mean, we definitely, you can buy an asset and you can do the value add play to it and be able to boost rents and do certain things we do have more control on than you do in most investments. But at the same time, we're sitting within this economy that we really don't know sort of what may be ahead of us. I would imagine that's one of those challenge areas.
Yeah, it's tricky, right? And I think there are a lot of people in a lot of industries who would like to know what the economy is going to do. And, we, as do a lot of real estate investors, we pay for very smart economist research to try to give us some understanding of what's going to happen. I think at the end of the day, the reality is that there's not perfect information about what's going to happen with the economy. And so it's so important not to take at face value what assumptions are being used in whatever model that people are evaluating a deal. If you're looking at a deal, you can't just kind of say, well, I'm just going to assume this is correct. You really need to think about what's my upside here and what's the downside scenario based on what the economy does. And so we internally at MG, we spend a lot of time thinking about risk proofing deals and thinking about our downside scenarios and, what can a deal tolerate before we have a problem. And so we do that because you just never know. And, hopefully the economy does well, but we tend to be long-term holders. So the deals that we're doing right now, our expectation is that they're going to be 7 or 10 year holds. And in pretty much any 10-year hold in real estate, you're going to have some bad years and some good years. And so we just want to make sure that, I don't know whether those bad years are going to be years 2 and 3 or years 5 and 6 or years 8 and 9, but we just want to make sure that whenever they happen, we're capitalized in a way that we can ride that out smoothly and try to get through to the other side. So that's kind of our mindset here is buy good real estate, make sure we use an appropriate amount of debt if possible, and then just cash flow that, and then 10 years from now we'll be glad we own that asset. So that's kind of our mindset. And I think it's easy to read economic analysis and feel a little bit overconfident about your understanding of what's going to happen. And that's the business of forecasting economics.
Sure. Well, I think that taking the long-term approach is an advantage in real estate just across the board because it ultimately is going to go up, and the longer term you wait, the more you're going to see the corrections, and you're going to see the that growth curve moving upward. It may take some dives here and there. I mean, but the overall is property is always going to be worth more, down the road. So I think that, that's a smart approach. I think those that are working on short term, 3 to 5 years sort of, they do the big cash out at the end, and their exit strategy is, a short term like that, I think run maybe a bigger risk than the approach that you're taking. It looks like.
Yeah, I feel like, on that note, I think most investors sort of underestimate the uncertainty associated with the economy, right? And so you either you think that the economy will grow, or perhaps rents will grow, between 3 and 4% on average over the next couple of years. And I think if you look at history and you go back 30 years, and we've done this internally in each different submarket, we'll go back 30 years and say, what was volatility like? And it looks like over short periods of time, markets either really outperform or really underperform. And if you look over a much longer period, they all converge to much more smooth, kind of steady growth over perhaps like a 10-year period, right? You get very few markets that do really bad for 10 years straight or really well for 10 years straight. They all kind of do okay. And so I think if you have that short-term mindset, there's a little bit of Russian roulette involved, in that if the market does well, you're going to do great. And if the market doesn't, then you're not going to do bad. You're not going to do well. And you don't have an exit plan at that point. And that's what makes it hard, because, real estate, like you said, over the long term is a great investment. You just don't want to get marked to market at the worst possible time and have to give a property back to the lender.
Right. Yeah. And the economic cycles with real estate, again, you go back, like you said, and you can trace it, and you can see, you can see the hills and valleys, you can see the peaks, the bubbles, and there's been, somewhat predictable, just a pattern there, but we seem to be in a time right now where that it's setting sort of a new precedent here. It used to be sort of 8 to 10 years. There would be a bubble, and then there'd be a decline, and then there'd be another growth period. And then, but we're way past like 12 years here. So and. How are you looking at that? Are you making any kind of assumptions in terms of what you think or when you think things are going to happen?
Yeah, it's been, I guess, the longest, expansion in U.S. history, right? So it's been fantastically long, and in some ways, it's not been as large of an expansion as some previous ones, just because the rate of growth has been a little bit lower. But that being said, I think most groups think that we're late in a cycle, in an economic cycle. So I'm not going to kind of pick a downturn time, but what that means for the way that we approach our business is we are trying to be real appropriate with the way we use leverage. And what that means from a practical perspective is we're in the preferred borrower channel for Fannie Mae and Freddie Mac, and that means we get the best possible pricing. We use lower levels of debt, so we typically use 60 to 65%, 10-year full-term interest-only fixed-rate debt, and we like the full-term interest-only because that really helps drive cash flow to our investors, but also that creates extra cash that's coming out of an investment that we can use to address capital problems or just solve issues if there were to be a downturn. So we feel like that's a defensive way to approach the business right now, and of course, with where capital markets are right now, the debt that's available is absolutely amazing. We have been pretty fortunate to get some great rates lately. We just locked rate on a 10-year deal yesterday at 3.23% for,
gee whiz.
which is just unheard of, right? So that obviously cap rates are lower, but there's still positive arbitrage there. That's still going to drive cash flow. So. So the way we look at it is use less debt, get very attractive long-term fixed rate interest-only debt to avoid as much as possible risk during the hold period, and then just buy good real estate. And 10 years from now, it'll be fine. So that's kind of been our approach. And I think there will be a downturn in the next 10 years. I think a lot of people would say that's pretty likely. So we just want to capitalize our deals in a way that is going to get through that successfully to the other side.
Now, when you started with MG, it's like 2010. I mean, you were at a point where there was quite a surge going on at that point in real estate. Did you have a different strategy at that time? I mean, because that was just coming out of the recession, and things were just, properties were doubling in value. Is crazy. Right. It had to be an interesting time to join a firm like that.
Yeah, it was great. I think the benefit to coming on board here in 2010 was that The company MG's had an amazing track record historically. So we did not, we did not lose any properties in the downturn, unlike some of our competitors. And so we were in a stronger position, I think, to take advantage of the upcycle because we didn't have, as many legacy assets that had to be dealt with that were distracting us from new acquisitions. So when I came on board, it was really all about, how can we take advantage of what's happening right now as effectively as possible. And so I think at the end of the day, our strategy fundamentally hasn't changed, which is, we look at deals that tend to be 80s and newer. They tend to be larger apartment properties because we self-manage, so we want to be very efficient with our management, and the larger properties are more efficient. And we have very set target markets, and we expand very kind of incrementally into other markets, one at a time. And so, when I started in 2010, we were aggressively looking for deals. It's, on paper, 2010 looks like it's strongly in the recovery, but I think in practice, the feeling in the air in 2010 was that everyone was still terrified. And especially on the institutional side, it was still very tough to go out and find institutional partners for deals. And on the private side, a lot of our privates were still in risk off mode. They had the denominator effect at that point, right, where the stock market was down, and that made them feel over allocated to real estate. And so, just the capital raising side was a little trickier in 2010 than it is today, when the opposite is true. And the features of the deals we were looking at were, you look at a deal and the cost basis, the price per unit and the price per foot would be really, really attractive, right? You'd say, I'm getting an amazing discount on this, but the cap rate was awful, right? Because rents were down so much and NOIs were down so much. And so it definitely took, it wasn't a no-brainer on paper. It took some belief that there was going to be some really above trend market rent growth, which of course there was. But if you have the mindset that you say, well, yeah, I'm just plugging in, 3% rent growth no matter what, and I'm going to be conservative because of that, it would lead you to not do deals in that environment. And so I think a lot of groups missed out on that recovery. And the interesting thing about that last downturn too was there wasn't the distress from the RTC days where there were so many deals coming to market and prices were really depressed. The prices didn't go down as much in the multifamily space just because, lenders or other owners didn't have to sell for the most part. There just weren't as many distressed sales. And so the transaction volume just went way, way down in the institutional apartment business while everyone just kind of rode out that rough time. And I think as a result, the market, it ended up being a good defensive place to be during the downturn in comparison to some other asset classes. But it was tricky to take advantage of it because you really had to get what seemed at the time, it seemed like you had to be really, really aggressive to go buy deals in 2010. In retrospect, of course, you could have bought anything and it would have been great.
Yeah. Did you do more shorter term, or were you still in that the long-term mode that you're in now?
Yeah, it was, our bread and butter is doing long-term investments. We did a couple of short-term deals that were a little bit more opportunistic. Sometimes we'll look at a deal and just say, this is just such a natural sort of short-term hold because some specific thing needs to be fixed. And so we want to match our debt to our business plan. So there are situations where we'll put on floating rate debt, either because of an asset sort of attribute or because of a market attribute where we feel like we want that flexibility to hold it for shorter term. And so we did some of that. We used some higher leverage when we were, farther back in the recovery, and we felt like there was a lot more certainty in terms of what direction the economy was going over the medium term. So we had a couple of deals that were, in the 70 to 80% range for debt that worked out very well. We tried to match those to deals that had very high cap rates, and we felt like there was a lot of downside protection, even though the loan to value was higher. So it was very deal specific then, whereas now we tend to be a little bit more focused on kind of bread and butter down the middle of the plate. You look at the bell curve of quality of assets, right? And we try to lop off the the low end where where there's high crime and very difficult capital issues that need to be solved. Functional obsolescence, we try to stay away from that. And then the really, really core side where it's new construction, there's a lot of pipeline and uncertainty in that space at the moment, we're kind of staying away from, and we're just right down the middle of the plate, bread and butter operating deals.
Gotcha. And what markets are you in, Paul?
So we're in Washington, Oregon, California, Arizona, and Nevada. And we're fairly evenly distributed amongst that. We're based in San Diego, so we do have maybe perhaps a little bit of a home bias in Southern California. We have a lot of assets. And in Phoenix, we have a good portfolio. But really in all of those markets, we have over 1,500 units. We have regional management that's out there to make sure that they keep an eye on our deals. We try to keep that scale in each of our markets to make sure that we are really efficient and that we know those markets really well. And that helps us obviously on the operational side, but also really helps us on the acquisition side, because when I'm looking at a new deal, I can go tour that deal and then I can swing by our property nearby and say, what have you heard about that deal? And, what do you think about it? How does it compare to our deal? And really get some insight from our operations that helps us, I think, make better decisions. We've done a number of deals that are right across the street from deals we already own, and we love those from sort of an operational perspective. So having that presence in the scale in each of our markets, I think, is really important to help us make good investment decisions.
Oh, that's great. That's great. And those markets are, they're hot. The West Coast is hot. It's definitely up there in terms of compressed cap rates, but it's still just one of the big areas right now in terms of just growth, and it's still happening. And so I'm sure you're experiencing a lot of that. Well, gosh, I could just talk, just keep talking to you here. And I want to try and pull some things for our listeners that I think might be of real advantage. And I think your experience in acquisitions, your as a person who puts deals together, who evaluates deals. There are a number of our listeners who are passive investors, and that just being able to discern what is a good deal and what isn't a good deal, I think is invaluable. And when you're looking at so many different things out there, it's competitive. I'm sure from your standpoint right now with the international and institutional, guys that are coming into the field, and but it's also very competitive, for those that are out there looking for something that they can invest in and have some peace about that decision when they do select something to invest in. What kind of information, what kind of advice would you have for some of our folks that that are looking at syndication? But I want something that it will be that the sponsor is somebody that can trust, and that I can expect a reasonable yield.
Yeah, there's so many parts to that question, right? So I feel the pain of being an investor, having been on that side of the table and having to look at the blizzard of different offerings that come through from different groups and trying to decide what's the best strategy. So, I definitely know what that's like. And then obviously I'm on the other side of the table right now, putting together deals and going out to investors. So, I would say that, both sides are complicated in their own way. So I would be remiss if I didn't tell people about the book that I wrote a couple of years ago. It's called Investing in Real Estate Private Equity. And I actually wrote it under a pseudonym, Sean Cook. But if you plug in either my name or Investing in Real Estate Private Equity on Amazon, it'll pop up. But anyway, I wrote it under pseudonym because I just wanted to give people honest advice about how to invest in the space as a passive investor and do that from the ground up, because I feel like there's just a lot of salesy advice out there and a lot of get rich quick schemes, and I just kind of want no part of that. So anyway, I think one thing that I'd say in terms of how to approach passive investing right now in the space is if you are thinking about being an active investor and you don't do it already, I would say just be real confident if you're going to make the decision to go active right now, because like we said, I think we're later in an economic cycle, and you want to make sure that you have the economy ready to bail you out if needed. And learning something is always more complicated than you think. So I'm a big fan of passive investing, and I feel like general partners, operators like ourselves, we bring a lot to the table when it comes to putting deals together in terms of efficiency, experience, relationships, capital markets. And so I think the most important thing when you're evaluating potential passive deals is to pick a good sponsor. And the reality is that being on the other side where we put together the models and put together the forecasts, not all forecasts and projections are created equally. Some sponsors tend to be very aggressive about the way they underwrite and project much higher returns, and some sponsors tend to be conservative. And what you have is the sponsors who don't really need the investment have no motivation to be overly aggressive and promise too much to their investors because they have plenty of investors already. And so you get a situation where some of the highest returning deals on paper are from sponsors who are not that experienced and just need to get the capital, and so they're willing to take more risk. And that's so you can't necessarily look at multiple deals and just assume that they're underwritten the same way. There are some things you can look at in the underwriting, but my personal opinion is it's so much more important to pick a good sponsor. And that means a group that's been around for a long time, a group that's active in the market. So they're going to get preferred, deal terms. They're going to get deals coming their way from other principals because they want to do future deals together. They're going to get the best debt terms, and they have the best analysis because they have a big portfolio already that they can rely on to make good projections. So I think picking the sponsor is kind of step one in being successful in picking the right real estate deals.
I know this is also a loaded question too, but how do you find a good sponsor? How do you know? What's sort of the criteria that a potential investor would take into that? I mean, a lot of the folks listening are people that they've worked their lifetime. They put together this nest egg that's going to carry them through their retirement. And they don't want to gamble with it. Some of them might have already been hit, during the downturn, and they don't want that to happen again. So, I mean, I know this is the loaded question, but it maybe some practical steps that people can take to at least hedge their situation there to being able to select a good sponsor.
Yeah, absolutely. I think, and I talk about this in the book a little bit too, is I think even before you pick investments, the most important thing to do is to step back and think about, talk to your financial advisors and think about your portfolio holistically and say, all right, this is my investable portfolio. And then say, I want X percent of that to be in real estate. You start with that allocation. All right, what's my real estate, investment allocation going to look like? Do I want REITs? Do I want private equity deals? There are a lot of options for real estate exposure. And then, once you pick the strategy, then, what do I want within that? Do I want office deals, or do I want multifamily deals or self-storage, et cetera? Do I want to be investing in equity or debt or mezzanine or preferred? And so there's a whole host of decisions that you make. And then at that point, once you have an allocation that you feel good with, then you say, look, I want to be in the multifamily space, and I want to have an allocation of, let's say, $500,000. Who are the best multifamily operators out there? And then you go out, find them, get introduced to them, look at their track record and vet them, and then you're all ready to go once they have an offering. That offering comes out, and you're ready to say, all right, I'm in, or I'm not in for whatever reason for that particular deal. So I think that's kind of the progression of steps, and to find the best operators, that is a little bit tricky, right? Because our space for so long has been it is still very heavily regulated, and so companies like ours, with the exemptions that we use, are not able to go out and advertise to potential investors. And so, and we don't put our offerings, for instance, on our website. So it's not easy for an investor who's not already familiar with us to find an offering and invest in it. So there's a whole kind of series of steps to finding those groups. And I think probably the easiest thing is just talk to a lot of people. So perhaps talk to your accountants or financial advisors. Ask them if they know of operators in a space that you're looking to get into. I'd look at trade magazines, and just doing some Googling can tell you who the active buyers are in any particular space. You could look at something like, CoStar has a lot of information. In our space, MHN, Multi-Housing News has a lot of information about transactions that happen. And so you look on there and say, oh, well, the active buyers in Southern California are these, dozen groups. I'll look at those dozen groups and see if any of them are doing private syndications, or are they funds, or how does it work? And then you can kind of come up with a short list of groups that you want to research because they're active, and then dig into those a little bit more to figure out which ones would be a good fit for you.
Okay, that's great. Yeah, that was my big question: is where do you find these folks, and is there a a list, or is there? I mean, I think it's like the Forbes top operators and multifamily list or something. But
well, there are some lists out there. There are. You can look at lists of the largest apartment operators out there, right? And some of the trick with some of the lists is the lists tend to be the biggest whatever, as opposed to the best whatever. And the biggest may end up self-selecting you into, oh, here's a list of all the, real estate investment trusts in the space, or just, the very largest groups, as opposed to perhaps, groups that are maybe a little bit more selective about what they do. And so I don't think there's any easy answer to that, but I think being an active transactor, buyer and seller in the market, is an important part of getting good deals in the first place, and not paying too much for good deals when you get them. And so you want to look for active groups, and that's a good place to start. And then once you start digging into those groups, you can pretty quickly check them off your list, or look at them in a little bit more detail.
I talk to a lot of investors, as I'm sure you do too, and one of the things that investors will say is that some of the larger groups are great. They've got great track record, but the yield is lower than it is than sometimes smaller investors, for example. Do you think that's an accurate statement?
Well, yeah, I think. If I understand that question correctly, I think that it is true that yields are lower on paper on larger institutional deals. I think there are a couple things going on behind the curtain there, and one of them is that large institutional deals, you tend to get operators who are a little bit more conservative and long-term oriented in the way that they approach the business. And so you just may get a little bit more conservative underwriting out of them. And we talked a little bit about not all underwriting is created equal. And so if you have, perhaps a more startup operator who's buying, 4, 8, 12 unit apartment complexes, they may either need to be or just want to be a little bit more aggressive about the way they approach their investments. And what's hard about our business is it's easy to compare quantitatively returns from different offerings, but it's hard to quantitatively compare and evaluate risk in deals. And what we're all really looking for is, what's the best risk-adjusted deal out there, and how do I fit that in my portfolio? And so it's easy to look at, this offering is a 10 IRR and that offering is a 17, but it's not as easy to dig into that and say, well, the business plan here and the assumptions are not realistic. And so, that's either going to be, that 17 is either going to be a 17 or it's going to be a, negative 17. And so assigning a probability to that is a little tougher. Whereas maybe the lower risk deal is, it's a 10, but, maybe it's an 8, maybe it's a 12. So, I think that's where, we were talking earlier about sort of the art of the practice, and that's really picking the best operators, number one, and then trusting that they're out there trying to find the best deals that they can find. And there are definitely some things you can do. I think once you get into the business and really start evaluating offerings, and it's like anything, I think the more offerings you look at, the more PPMs you read, which I really encourage your listeners to spend time reading the detailed, extremely boring private placement memorandums, because they really tell you everything about the risks of the deal and the business plan for the deal and the operator. I mean, that'll really, if you can get through a lot of those, you'll start to get kind of an intuitive feel for who's being aggressive and who's not, risk profiles and, deal terms, economic terms, fees and incentives, things like that. So I think really just looking at a lot of deals is probably the best way to start to get a sense of how to compare on a risk-adjusted basis different deals.
That's great. Now, does your book have sort of evaluation guidelines or templates or things that people can use when assessing, a good deal?
Yeah, it does. And so we talk about a couple different things. I talk about a couple different things in there, just number one, kind of evaluating a sponsor and building an allocation. And then I talk about compensation and fees and evaluating those in an offering. And I think there's a little bit of misunderstanding about how compensation works for partners. And I think, number one, there are basically two types of compensation for real estate owner operators. There are fees where you're paid those regardless of what happens with the investment. And then there is incentive-based compensation, like a promote, where you split some amount of cash flow over a certain return. And so there's no right or wrong to those. The compensation tends to be a mix of the two. A lot of passive investors look at that situation and say, well, I want to align incentives by making sure that the owner operator only gets paid out as much as possible by the promote, because then they're going to be working hard to find good deals. But the reality of that is what that incentivizes sponsors to do is to take as much risk as possible, because basically that promote is a call option on real estate, right? So if you have a call option on something that's at the money today, you want as much volatility in that asset as possible, right? So because you're not hurt by a downside and you're paid out by a big upside. So that means you lever up, you buy riskier real estate, you assume a business plan that may or may not work out. And so I think investors who are really focused on getting alignment of interest by looking for operators who are incentivized mainly on promote are taking on more risk than they think they are. So I think there's kind of a healthy mix between just fees and promote. And so that's something just to think about as as a passive investor, is what incentives am I creating for that particular sponsor? And there's no kind of perfect mix. There's no perfect alignment. So it's good to just have a bit of both. And then in terms of evaluating the real estate itself, I think the main things to think about there are, number one, the underwriting models are extremely complex to evaluate. There are just so many moving pieces that it's really tricky to kind of get inside those and really understand what's going on. But there are a couple of kind of key things that you can look at, and one is comparable sales. So looking at other deals that have sold that are similar to this particular property and how they've traded on a per pound basis. So, per unit, per square foot, whatever the case is for the asset type, on a cap rate basis. Do those triangulate with the deal that you're looking at? Are you setting a new high water mark? Is there a reason for that? Maybe you just are buying a deal with really big units for some reason, or a newer deal than other deals. So that helps you really kind of understand what's been happening in the market. You can look at the rent comps, and that is going to really define how realistic your business plan is for the asset. So, look at those rent comps and see, well, if I improve the asset, are there other properties out there that support the level of rents that I think I'm going to get out of it? So that's something that's pretty easy to evaluate in an offering. And then, in terms of the actual cash flow model, I think the really important assumptions there are, number one, are your rent assumptions reasonable, which goes back to our rent comps point. Is your rent growth assumption reasonable based on what's going on right now? And then is your exit cap assumption reasonable? Because the rent growth and the exit cap are really the two biggest assumptions that end up driving returns. And so we spend a lot of time internally thinking about those. And we actually have a matrix on the front page of our executive summary for every deal where we look at what happens if we're wrong one way or the other about rent growth, and what happens if we're wrong, on the other axis about exit cap. What does that mean for a deal? Where are the pockets of risk in a deal, and what can it tolerate? So I think those are the main things to look for in deals, and you can start to compare those across different deals and see how they compare.
Good information, man. That's great. Great approach. Wow. Well, we're kind of zooming along a little faster than I thought. It's just, man, I'm thinking I've got to have you back on. We've got to, I don't know where we're going to do it. Maybe just talk the economy, and then another time we'll just do, some passive investing. But it's just, there's a lot that you have to offer, and I really appreciate this. This has been fantastic. Just looking at your company and what's going on right now, and you've been there for a number of years. Where do you see the company going, or maybe different things that it might be doing? Or are you going to pretty much just kind of sort of say status quo and do things the way you've been doing them?
Well, the company has been doing the same thing for 27 years now. Mark Gleiberman, who's our principal, started the company buying some smaller San Diego apartments here with friends and family back in the RTC days, and grew that over the course of time to 20,000 units. And we've always had the same focus. So we just buy existing apartments, we fix them up, we manage them in-house, and we try to manage them for cash flow. And so I feel like this world is so complicated that when you step out of your lane, it's easy to make mistakes. And especially the way the economy is right now, we want to make sure that we're really just focused on what we know and what we do well. So I think, my expectation for our plans here is to keep doing what we do. We're going to stay, in our markets. We're going to be buying the existing kind of B and A minus multifamily properties and fixing them up. And we're just going to keep doing that for right now. So I don't expect any big changes. And I think what we've heard from our investors is they, in comparison to the other investment alternatives out there right now, they really view investments with us as being a defensive part of their portfolio. And so we just want to make sure that we continue to kind of do what we do and play that role. And that's going to mean, probably continued lower leverage deals, continued focus on kind of downside protection and cash flow.
Great. Smart. Well, we have a area we call our Wrap It Up. It's near the end of our show here, where I ask you a series of quick questions, and you reply with resources that have been valuable to you, so that people can know what you're reading and what you're doing and where you're going, because that helps our folks in terms of their efforts to learn more. And so, if you are ready, do you want to jump into the Wrap It Up session?
All right, bring it on.
All right. Favorite real estate book?
Okay. Well, obviously my book, Investing in Real Estate Private Equity by Sean Cook, but outside of that, which is a fantastic resource, I'd say, I just read Sam Zell's book, Am I Being Too Subtle?
Yes, I've heard about that. I want to read that so bad. I hear it's excellent.
It's great. It's really entertaining. And, he's just, obviously, he's a big character, has been phenomenally successful in his life in investing. And it's just, clearly there are a ton of, investment nuggets that you can take out of that in his approach to investing. But it's also just a completely entertaining book. And, just the stories that he has of building his company and managing downturns and opportunistically coming up with deals. It seems like it was an incredible ride for him. So that was a really fun book. I definitely recommend that one.
Great. How about just a favorite general business book?
Oh, a book that I really enjoyed reading recently is, I guess this is a business book. It's called Extreme Ownership, and it was Leif Babin and Jocko Willing. And they wrote a book. They were in the Navy SEAL teams, and they wrote a book about applying the leadership principles that they learned as Navy SEALs to business. And, it was, not only is it just really well written and entertaining to read, I came away from that thinking that that could have substituted for any, leadership or business class that I ever took. It was just really well written, really practical, and really entertaining too. So that one's worth a read.
Another great recommendation. Excellent. How about most valuable website for success other than your own?
I guess the way I'd look at that is it's the most valuable thing is to look for websites and information from groups that don't necessarily agree with your priors. So if you have an opinion about the way the economy is going, to read people who disagree with that opinion and that challenge it, so that you can really think about, what if I am wrong, how am I going to be wrong? And what does that mean to the way I'm approaching my investing? So I think it's just really important to keep us all humble about the way we're approaching the business and not reinforce the things that we already think.
That's very wise. That's great. Yeah, that's good. I don't know if I could put a link on that, but I definitely.
Yeah.
But I think that's good.
Right. That's a little tricky.
I still like it. I still like it though. I think that's very wise. How about a favorite app on your phone?
Oh, on my phone, I would say, hands down, that's Audible. I am a big listener of audiobooks, and when I can, I try to ride my bike to work, which is about 45, 50 minutes each way, or I'll go for a run in the mornings. And so I have a lot of time on my way to and from to listen to books, and I don't always have a lot of time to just sit down and read. And so it's just been a lifesaver for me to be able to read, and I've just blown through so many books that way. So I don't know what I'd do without audiobooks anymore, and Audible's a great site.
I love Audible. Yeah, that's great. How about favorite quote?
Quote, I'd say probably Albert Einstein. He said, try not to be a man of success, but a man of value. So just don't worry about the outcome, like Coach John Wooden said. Focus on just doing the best job you can and let the rest take care of itself.
I love it. That's great. And this one is a little bit more tricky here. If you lost everything you had, every asset you had, no longer working for your company, but you've got $1,000 in cash in your hand, what would you do with that $1,000 to rebuild your business or your real estate investing, or sort of rebuild your life there at that point?
Yeah, that's a tricky one. $1,000 isn't too much, right? So I'd say with $1,000, I think, especially if I was earlier in my career and getting going, I'd take that $1,000 and I'd buy a suit and I'd go to the very most successful groups and go offer to work for them and build myself back up that way. Because there's just, it's so important in the real estate industry to be part of a successful team and use that to your advantage. That it's, if you're starting out on your own with no resources and no reputation, it's a long road. And so doing everything you can to work with people who have a good reputation and do what they say they're going to do and are active buyers and are out there doing deals, I just think that's the key to being successful in the business, because otherwise you're just walking uphill.
That's great advice. I like that. Well, we are going to have a link to your book here, definitely, so people will be able to see your alias and also be able to also you should explain too why if you don't mind, why you put an alias in there. I think that's
Yeah.
a noble purpose.
Yeah, well, it started out because I spent a lot of time on the airplane, right? And I was just kind of bored. And so I started just writing down some notes. I got a lot of questions from friends of mine. They would send over deals and ask what I thought of them. And so it was getting really time consuming, which I'm always happy to look at people's deals and kind of weigh in on them. But I just thought, I should write down some thoughts on what to look for in deals so that I can just give those to my friends and they know, like, oh, well, when I get a deal, this is how I should approach it. And so I started on that, and it kind of grew a little bit over time. It kind of grew a little bit more. And then eventually I looked at it and said, I should just kind of make this a little bit more widely available. And there are just so many in the real estate business, especially at this point in the cycle, there are just so many people out there selling a get-rich-quick scheme, and their method for investing in real estate and making money with no money down, and a lot of people out there just trying to sell themselves. And so I just said, I'd rather just put some good advice out there and just let it take its own course. And so it was more of just kind of a fun hobby for me. It's definitely not a moneymaker. So I put an alias on it, and that way most people come across it just, I think, randomly through reviews on Amazon or referrals from other similar books. And they come across it, and then when they read it, they have this advice, and they know that it's not really me trying to sell anything to them, sell a program to them, anything like that. It's just, this is what I think. And a lot of the advice in there is not the conventional wisdom that you hear, because conventional wisdom in the real estate business is a lot of times meant to enrich one person or another. So it goes against the grain in terms of the way it approaches the business a little bit. And I think people like that. I hope they find value in it.
I love it. Oh, that's great. Well, there'll be a link definitely for the folks here. And also, can you provide information if people want to check out your company and find out more about what you do there, and maybe even receive information from your company?
Sure, absolutely. They can, if they're interested in reaching out, they can reach me at Paul, Paul, at mgproperties.com. That's MG like the car, MG. And or they can look at our website. It's mgproperties.com as well. So you can take a look at that, and we're always happy to chat with folks. Shoot me an email, and we'll go from there.
I love it. That's great. Well, Paul, we have a tradition here on the Old Dogs REI Network that I'm sure you're well prepared for here, but we have all of our guests close us out. We're called the Old Dogs Network, so we had to have something tied into that name. And so we have our guests give us their closing howl. Okay.
All right.
I know you're in an office, and this is probably going to attract some attention, but hey, you could win the Golden Howl Award. You never know.
We're in the investment wing here, so everyone expects weirdness.
Probably a lot of people howling, Oh no.
All right, here you go. Ow.
All right, that was a safe one. That was good.
I feel like that was maybe a little bit too mournful. Maybe I should have practiced it, but I'll work on it for next time.
It's okay. It works. Yeah, and we're definitely having you back for next time. I'm going to hold you to that, Paul. Well, thanks so much for joining us. This has been outstanding, great information, and I know our listeners are going to really get a lot of value out of this. So thank you for joining us, Paul.
Well, thanks for having me, Bill. It's been a pleasure.
Likewise. And I also want to thank all our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate that. Please note, everything we talked about will be accessed in our detailed show notes. So we're going to try and decipher everything that Paul presented today and have that so that you can use that as a reference as well as links as they were mentioned here as well, and some good reference points as well. So just look for the episode with Paul here, and you should be able to get all that information. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.